we completely agree. Short term bad for Bitcoin, short term good for gold, longer term very good for Bitcoin, and it keeps me very bullish things like gold, very bearish things like the stock market, and broad cryptos because I
According
don't
to
think.
senior Bloomberg commodities analyst Mike McGlone, Bitcoin shows promising long-term potential. Mike cautioned that the Federal Reserve's necessary response to concerning inflation data will have a negative impact on commodities and the overall market. According to Mike, the risks of a Bitcoin rollover are leaning towards deflation. Based on Bloomberg data, gold prices have shown a year-on-year increase of approximately 10%, positioning it as one of the top-performing major assets. Conversely, Bitcoin experienced a decline of nearly 20% during the same period, while the S&P 500 maintained a relatively stable position. These trends highlight the ongoing pattern of gold prices outperforming Bitcoin in the current market scenario. In a Bloomberg television interview, Treasury Secretary Janet Yellen emphasized the possibility of defaulting on certain obligations, such as treasuries or payments to Social Security recipients.
When you hear the Treasury Secretary Yellen saying the word default, it just makes me cringe because that's an oxymoron. Maybe there's some kind of goofy political issue and they delay a payment and then pay it up later, but it just makes me cringe, and it keeps me very bullish things like gold, very bearish things like the stock market, and broad cryptos because I don't think this is going to come to an agreement until markets make that. And it's just what had happened in 2011. You drop the stock market down hard, and they'll agree because they'll realize, okay, we're going to crash the global economy. We'll meet in the middle. And I don't know. I'm trying to avoid the nuances, but even without the debt issue, once we get past it, I think what's the best case is we wake up morning and they have an agree in the morning they have an agreement. So what do you have? A risk asset rally. Everything will pop up. Bitcoin probably the most. But I think that's unlikely. I think the more likely scenarios, markets make them come to agreement, which is what's been happening. Bitcoin's gone down from the peak at 30,000. So I'm just looking at the 52-week average in Bitcoin right before COVID kicked in was 7,400. That seems pretty low, but that's just where it was before we had this biggest pump in liquidity in the history of mankind. S&P 500 right before, the 52-week average right before COVID kicked in at the end of 2019 was 2,918. So that's what 30% below here. I like to make the point is what stops a normal correction to those kinds of levels. I hate to say it, but that's just facts. And the key point I question myself is the dominoes have already started falling. First of all, we have the rates going up. Typically, my entire career, you need liquidity for risk assets to go up. Okay, well, we're still doing the liquidity rug pull. That's the situation. And you're seeing in the forward-looking markets are starting to go that way. Like I mentioned, the ones that have are lumber, natural gas, and all my commodities are going there. I keep asking, well, what stops these other markets from falling? And everything trickles down to, for Bitcoin to stay up here, you need the stock market to stay up.
To address rising inflation, the Federal Reserve has been gradually increasing interest rates while ensuring sustained economic growth. However, potential vulnerabilities are beginning to surface in this strategy, leading to speculation that the Fed may soon change course and slow down its rate hikes. In a recent analysis of the cryptocurrency market, McGlone highlights the potential impact of Federal Reserve tightening on various risk assets, particularly cryptocurrencies. Despite the risk of a recession, he suggests that investors adopt protective measures as the bear market may not have concluded yet.
Right now, we have Fed funds at about 5.1%, and the futures are priced for 4.4% at the end of the year. So basically 70 basis points of cuts. Virtually all economists, everybody disagrees with that. Fed governors disagree with that. And there's one key little factor that can make that happen. Stock market going down. What's the one key thing that can help transition our leaders to say, all right, we better come to agreement, stock market going down. Now, it's not happening, but these are the kind of things that I look at it. It's every time in history I've seen this, it drives you crazy. And then all of a sudden, before you know it, it goes down harder and faster. And usually after my strikes would expire, which is how I don't trade anymore. And I knew you'd, but that's just how life is. And that's how it is. It's the human nature of it. Because I remember beating bearish really hard, just like the Big Short in 2007. and was able to hold on. But that was a key essence that I got out of Big Short, having worked with clients my whole life, is you can be completely right in fundamentals and be wrong because of the timing. Now, that's everything. But to me, that's what's the number one thing that's going to solve this dilemma that I hear every meeting from our strategists, everything. The Fed is not going to ease. And even the governor said they're not going to ease. Yet the market's priced for it because we all know what will make them ease. The market's pricing in for normal deflationary recession in terms of Fed funds, and the Fed to do what they normally do is start easing when things get bad economically. The point is they're probably not going to do that with how much they've done in the past. Now, as far as pricing for what might happen with a default or delaying payment, that's already showing up in CDS levels and in just certain yields on certain T-bills right next to each other. But that's not my picture is the macro. And either way, it's lose-lose, I see.
According to McGlone's prediction, an impending recession could have a negative impact on the crypto markets. Additionally, investors may shift their focus to treasury bonds, leading to increased yields. This shift in investor sentiment towards treasury bonds is expected to further contribute to the challenges faced by the crypto markets. According to McGlone, the current situation in the financial markets reflects a historical pattern where liquidity-driven booms are followed by market busts. This is evident in the sharp decline of commodities and producer prices. The key concern now lies in determining the extent of the impending market downturn. He predicts that the current trajectory is leading us towards a significant deflationary recession.
One little piggyback, and I think predicting the future, we are clearly heading towards a significant recession, and history, I think, will blame Chairman Powell. Unfortunately, he's just stuck in the wrong place at the wrong time, making some bad decisions, and because of this focus on inflation, which I get, yet the signals of the biggest pump in liquidity in history, the biggest dump in liquidity in history that I was way too early and I was wrong about, but are clearly showing up in all my leading indicators that we are collapsing. The producer price index has never fallen as fast as it is right now. It's actually negative versus about almost minus 3% versus Fed funds. That's clearly economic contraction from one of the top high beta measures of inflation. Copper's collapsing. All the major metal commodities are collapsing, and even earnings are down by 10%. I mean, that stuff's still sticky. But to me, this is where we're going to look back at this from the future and say, you saw the signals, you look back at the wrong levels, you let inflation get out of hand, and then when the credit crisis picked up, which you kind of somewhat created because you raised rates too much, you didn't. You obviously put one off. Dave mentioned you helped with liquidity, but you kept raising rates. A year from now, I think we're going to start seeing that his legacy is going to go down in history as creating one of the biggest potentially depressions in history. And that's just based on simple facts of studying cycles in history of pumps and dumps and liquidity. That's basic facts. Hopefully it won't work out this way. Hopefully it'll be different. But it's all lined up that way. And it's like, I point to give me a good sign in commodities, maybe sugar, good luck. I look at the broad index down 24%. What happened to all this bullishness out of China? This is just getting started.
According to Mike, the Federal Reserve's ongoing interest rate hikes will have an impact on risk assets, including Bitcoin. While he remains optimistic about Bitcoin's potential, he cautions that risk assets, including the leading cryptocurrency, are expected to encounter substantial challenges in the future. To wrap up our discussion today, we invite you to leave your thoughts in the comments section. If you found this content useful, please show your support by giving it a thumbs up and subscribing to our channel for the latest news and videos. Thanks for joining us.